Good evening, everybody. Hope everybody's having a nice spring evening. It's actually a very warm night here in Pittsburgh, Pennsylvania. So tonight we've got the pleasure again to have Brad Powell with us. Brad is a self-developed professional trader. So his techniques aren't, formulated through some theory. These are successful trading programs that he has done himself, and he is a professional trader, and he is the co-founder or co-developer of their company's current trading system, and actively trades futures and ETFs. So, Brad, we're anxious to see what information you have for us tonight. Welcome to the Candlestick Forum.
Thank you very much, Steve. I assume everybody can hear me okay. It's always great to be here. Thanks to Steve Bigelow and the whole gang at Candlestick Forum. We always always enjoy being here very much and working with Steve and such a great group of people that are truly a pleasure to work with. My name is Brad Powell. I'm from a company called Right Angle Trading. What we really specialize in right now or for many years, is the ETF market. We have a course designed specifically for trading ETFs, and the company was founded in 2003. And we also trade futures and other things, but Betty Crow, the developer or the founder of Right Angle Trading, really embraced the leveraged ETF market in 2008, as did I, and saw the explosive growth that it would have. And it has had that explosive growth. A few years ago, I did this webinar, and it was 10 or 15% of daily market volume. ETFs right now represent 45% of daily market volume, which is a staggering, mind-boggling figure to think that leveraged ETFs were really introduced to the public in 2008 when the SEC approved active management of ETFs to gain leverage. And in 6 years, they now represent almost half of daily market volume, and that just is kind of mind-boggling to me. How popular they are, not only as an investment device, but as a day trading or short-term swing trading device instrument. And what we're specifically going to talk about today is risk management. I'm going to show you some indicators that we use, some methods of assessing where stops are, where prime entries are, how to trail a position when it's going your direction, some tools that we use. But I want to start off by talking specifically about risk management starts in the ETF market before you ever place the trade. And if you think trading leveraged ETFs is exactly the same as trading stocks, that is not the case. They are different than their underlying index. Some of the traditional methods that we've used, for example, to look for retracement levels such as Fibonacci, are not necessarily going to work with leveraged ETFs because of a number of factors that determine their price. Now, you can trade them just like stocks, in your Ameritrade or E-Trade brokerage account. I trade out of Ameritrade, pay the same commission, but they trade differently, and there's a number of reasons why. And we're going to kind of talk about that as we look at some of the different factors that make up risk management when you're trading ETFs. And the first thing you should be aware of is the leverage that you select for your trade. What I mean by this is most markets, there's over 1,400 different ETFs to choose from now, so they cover virtually any market, sector, index, overseas markets, currency pairs, whatever you want to trade, there's probably an ETF for it. Most markets offer the unleveraged ETF that will track the underlying index, sector, or commodity perfectly. That's like the SPY for the S&P 500 or the DIA for the Dow Jones Industrial Average that are actual tracking stocks. And they're priced at the open and at the close to match perfectly by market makers what the move in the S&P 500 or the Dow Jones Industrial Average was that day. Leveraged ETFs don't really work that way. They're much more open to fluctuation based on supply and demand in the open market. And most markets offer a double leveraged ETF, which returns twice the daily investment return that corresponds to the underlying index, sector, commodity, etc. And I want to repeat something. This is so important, and you'll see this when you look at the profile of any ETF, whether it's double leverage or triple leverage. It seeks to return twice the daily investment return, not weekly, not monthly, and not annual. On any one given day, it's attempting to return 2 times what the underlying index does. So if the index goes up 1%, it should go up 2% if it's a double leverage, 3% if it's a triple. That isn't always the case, and over a period of time, that correlation will kind of fall apart, and we'll get into that in a few minutes. Then most markets, or many markets, offer inverse ETFs, which is a bear ETF. So it goes up when the underlying market or sector or commodity goes down, whatever it's tied to, and usually there's unleveraged and double leveraged. And then some markets offer, most markets now, triple leveraged ETFs and triple leveraged inverse or bear ETFs. There has been experimentation with more highly leveraged ETFs. The one that jumps to mind was something that was called the RTSA that traded on the NASDAQ. It was issued by Barclays, and it was a bear fund for the Russell 2000, and it was attempting to get anywhere from 4 to 6 times the daily return. The problem was they only experimented with it on a bear ETF, and the TNA shot up over the next year, or the Russell 2000 shot up for the next year. So the RTSA went from $100 a share to $0 per share. Nobody wanted to trade it, had no volume, so they did away with it. But most markets nowadays have a triple leveraged ETF as well. The second part of risk management, when we say before you ever place the trade, is understanding the volatility of the market you trade. So let's decide you want to try your hand at precious metals. So you're going to compare the silver market to the gold market. So a simple way to see which of those markets has greater volatility is put up a percentage-based chart and put up the 2 basic tracking stocks for gold and silver. GLD, which is an unleveraged ETF tracking stock for the price of gold, and the SLV, which is in green, which is silver. And if you do a direct comparison of them from one day when a move up started to the end of that move up, you can see that gold went up about 7%, whereas silver went up about 15%. So it had about twice the move up in the same period of time. On the way back down, silver went down more like 22-25% versus 10 to 15% in gold. So then at the first of the year, they kind of balanced out and tracked one another a little bit better, although there was slightly more movement actually in gold by 1% over that period of time. But generally speaking, silver is a much more volatile market than gold. And when you get into leverage, that becomes magnified. When you move to double leveraged ETFs, the AGQ for the silver market versus the gold market, those ETFs, this kind of dramatic difference between the size, the percentage basis of their moves is going to be magnified even more because of the premium and the derivatives, primarily options that are used to gain leverage, or in the bonds, options on bonds, futures on bonds, the different things that are used to gain leverage. Let's compare the IWM, the Russell 2000 tracking stock, tracking ETF to the SPY for the S&P 500. We all know the Russell 2000 is a more volatile market, generally speaking. And just by throwing up a percentage-based chart, you can see that when the S&P 500 makes exactly a 5% rise, the Russell 2000 makes 12.5%. When it comes back down, it moves down much faster. The S&P 500 really just stagnates and changes a few percentage points, but there's more like a 10% move down in the Russell 2000. So when you move into a triple leveraged ETF, these kind of moves are going to be exaggerated for a number of reasons that we'll talk about in just a second. Something else before you ever place the trade, when you're looking at the ETF market, there are so many different ETFs out there to trade today. Be aware of how gappy these can be if you're short-term swing trading and holding overnight. The reason being, first of all, let's look at the FXI daily. The FXI is an ETF for the Hong Kong 25, the large cap index. So it's the Dow Jones Industrial Average of the Hong Kong markets. What's the problem? It's pretty obvious. the Hong Kong markets are open while I'm asleep. You may be up all night watching the markets. I don't do that. I go to sleep at a reasonable hour and get up pretty darn early out here in Los Angeles. But their markets are trading overnight while the U.S. equity indexes are closed. So whatever that movement is going to be priced into the ETF at the open. And you can see the size of gaps. This is an unleveraged ETF. And you'll see that there's 3 and 4% gaps. So imagine if you're in a triple leveraged ETF, you need to be aware you could get dinged on a 12-15% overnight gap. So if that move goes against you, let's say you had gone short right here and it was going your direction and you've got your stop somewhere in profit and you think you're going to make money on the trade, you wake up and the FXI has gapped way beyond where your stop was and you've actually lost money on the trade. So this is something that's very important to be aware of. You'll see this in ETFs like the UCO, which is a double leverage oil ETF, because oil tends to be very active in the couple of hours, oil futures in the couple of hours before the U.S. equity index is open. So there can be a large gap in that ETF. Anything that trades overseas or that trades overnight, currency pairs, you need to be aware of those gaps. We do like trading the emerging markets, and I'll just talk about it briefly. There are gaps in the emerging markets ETFs. We're looking at the EDC daily. The EDC is the triple leveraged ETF for the MSCI Emerging Markets Fund. Many of the stocks that are owned by the fund itself are trading at the same time as U.S. equity indexes. Some of the Brazilian stocks that are very large holding, some such as Samsung are primarily traded on the Korean market. That's the largest holding of the emerging markets. So that's going to be actively trading while we're asleep. But while it does have gaps, it also has quite a bit of room for intraday trading. You can see the kind of move, for instance, here on this one day where it makes a 10 or 12% move in a day. That can set up for very good day trades and also for overnight holds. I'll just tell you that we at Right Angle Trading, we have a rule about it. If there's a larger than a 4% gap overnight in the triple leveraged ETF, we really leave it alone for the day. And if it moves more than 7 or 8% in a day, even if we have a signal, for example, for our end of day alerts, we're not going to take that because so much of the move may have been priced in and it could quickly reverse. So sometimes it can leave technical indicators at extremes because of the size of gaps, and that's important to be aware of and important to manage your risk. And we just feel, I've seen the EDC gap down before 12% or gap up 12%, and it's important to be aware of that potential risk before you trade something like it. You should always be aware of the liquidity of the ETF you're trading. And the reason I say that is some are seasonal, and some just never get any volume. We kind of have a rule of thumb. Until we see something trade for 6 months for a couple of reasons, we don't want to touch it. New ETFs are launched every day. Every single day there's a new ETF. There's a plutonium ETF out, or there's a beer ETF, a beer brewery ETF. Who knows? Every day there's something new. Somebody decides, hey, we should do an ETF for this. Well, some of them never get interest, and 6 months later they cancel that ETF. Every day there's also ETFs being taken off the market. So we like to see it trade for 6 months and make sure that it has consistent volume before we ever touch it. And an example of a very popular ETF with inconsistent volume, because it's seasonal, is the DBA Double Agriculture Fund. And you can just see that when you get into the spring crop reports how much volume it gets, but during the fall and winter months when agriculture is really done for the year, how little volume. I personally don't want to trade anything that goes from trading 150,000 shares one day to 1.5 million the next and right back down to 200,000 the next day. I know I don't want to hold it overnight, but as a trader, I feel like when there's low volume, you're going to get wider spreads, incur more slippage, and have greater risk that a stop might be bypassed. And if you have stop market orders sitting out there, it could get whacked, get dinged for a full percentage by the time you get filled in a fast-moving market. So this is something that while we might trade on a seasonal basis, or you might be interested in trading on a seasonal basis, be sure to look at its volume over the course of the year, and you compare it to something like the SPY that on a bad day is trading 50 million shares, and at $180 a share, it has a 1-cent spread. And on a good day, it's going to trade 300 million. You really don't have to worry about getting in and out with liquidity issues. You should always be aware of how the ETF tracks its underlying index. And I'm sure there's people here who have seen earlier ETFs. I always use this as the example because it's so extreme. But it happens to a much lesser degree over many markets, and I won't linger on it because I've used this for years as an example. But we see natural gas futures rise 30% while the UNG declined 10%. And it's because they were paying very high premium to get the net asset value or to try to track the price of natural gas, and they failed, miserably for a long period of time. While natural gas futures price of the actual price of natural gas flatlined, the UNG net asset value was declining, and it saw a really dramatic, about a 70% drop over the course of the year, whereas natural gas was up. Now, they've revamped it since then, and that's why I say don't jump in and start trading some brand new ETF before you've seen it track and actually have at least 6 months of history of it, see how it tracks its underlying index, commodity, currency pair, whatever it is, because I'll be honest, these are actively managed by individuals, and they can do it on paper all they want. And just like we've all found out the hard way, boy, when you start trading live money, it's very different than when you're trading. Everything looks perfect on paper, but when you're trading live money, it's different. Well, the same thing happens to the professionals that are actively managing these ETFs as they try to find the proper balance of, what options or what futures or what they're using to gain leverage, or to balance the net asset value to the price of the underlying commodity. And there's going to be a kind of an experimentation period for many ETFs. So we just would always suggest you watch something, trade for a while, and have it, like I said, at least 6 months, preferably a year of data. Just because something's new and out there and available doesn't mean you should jump in and trade it. And that happens a lot in the ETF market. The final thing when assessing your risk before you ever enter the trade is to understand your time in the trade versus derivative decay. And this is true only of leveraged ETFs because something like the SPY is going to track perfectly. So I've got Brad's basic rules of what's going to happen when you're in a trade with a leveraged ETF. And this is why I say they trade differently than stocks. They trade differently than the unleveraged ETFs like the SPY, the tracking stocks, the DIA, the QQQ. The leveraged ETFs are going to trade very differently. So most of the time, if the trade goes in your direction, leverage will work with you in the short term. And what I mean by that is you're going to get greater than the 2 or 3 times what it should return of the underlying index. And you're going to get greater for a number of reasons because the premiums, and they're typically using options to gain leverage, and the premiums in those options, if the trade is your going direction, are going to go up faster than the market is moving. At the same time, there's going to be supply and demand out of balance in the open market, so the triple leveraged ETF is actually going to give you a higher return than it should. And in short term, I mean a 2-week period or less. If the trade goes in your direction, leverage will work against you in the long term. And that means you're not going to get the triple leverage or double leverage that you expect. You're not going to get 2 times the return over the long term, meaning a month or longer out. You're going to get less than what you expect. But the flag there is your initial risk is always going to be at least, the equivalent of 3 to 1 or 2 to 1, depending on the leverage. Almost all of the time. And I would say all of the time, but I'm going to say almost all of the time. Let's say 99.9% of the time, because one thing you never do in the market is say always, because the second you do that, something will prove you wrong. So I'll say almost all of the time. If the trade goes against you, leverage will work against you in the short term. And if the trade goes against you, leverage will work against you in the long term. Why is leverage working against you? Because you've got the market going against you. And you also have derivative decay working against you. So you've got a double whammy going on there. So let's look at the first principle of, in the short term, how can leverage work in my favor? So we're going to look at a move from the middle of February to the 1st of March. So a 2-week period, very short, not even 2 weeks, really about 8-day period. 8 trading days. A move in the Russell 2000, a strong move up. So the IWM, the tracking stock for the Russell 2000, moved 6%, 3x. If you were in the triple leverage TNA, should have given you 18%. Instead, it returned 20%. So in that short time period, you actually got more out of the trade than what the 3x should have returned. And that will happen day in and day out in the triple leverage ETFs. I did this same webinar yesterday somewhere else, and I keep forgetting to change this graphic to 2014, so please forgive me. November 1st, 2013 to March 25th, 2014, the SPY, meaning the S&P 500, gave a 6.75% return. Triple leverage should have returned 20.25, but it didn't. The UPRO only returned 19.17%. So it cost you over 1% based on what you thought you'd get, and yet your initial risk was exactly 3 times what it would have. I'm sorry, I accidentally muted my mic. So my point being, you think you're going to get 3 times return in the long run, but you're not. But now let's jump and see what happens when a trade goes against you. From January 3rd, 2014 to March 25th, 2014, IWM went up 2.73%. So let's assume that you thought, I think the first quarter is going to be bad. I want to be in a bear fund. I'm going to pick the triple leverage TZA, and I'm going to buy something. I'm going to hold it for 3 months, for this 3-month period. 3X inverse ETF, bear ETF, should have had, based on the 2.73 and 8.19% loss, but the TZA actually lost 13.3%. So you would have lost 5% more than what you expected. Why is that? Well, there were several reasons. As we saw earlier, the Russell's a volatile market, so things have a tendency to overshoot based on supply and demand in the open market. And the TNA TZA trade phenomenal volume, 20-25 million shares every day, day in and day out. So liquidity is never an issue with them, but the derivatives that they were gaining to use leverage, which were puts, were bear ETFs. They're paying premium for that. Premium's going away. So on a daily basis, it may hit that 3% number, but every day there's going to be a little bit of a difference in where it opens, and over time that's going to add up, and you're going to end up with 13.3%, or you would have ended up with 13.3% loss. So the bottom line is there, when the trade goes against you, leverage is going to work against you. Earlier I made a point, and I'm going to bring it up now, and because it kind of ties into what we're talking about here, which is some of the traditional tools. If you're trying to chart, let's say the S&P 500, and you expect, Fibonacci 50% retrace. Let's say you're charting, you're looking at a 1-week move up, there's a little bit of a retracement, you expect a 50% retrace. Because of this principle that I've shown right here, you can't say, well, I'm going to set a trailing stop a little bit below that 50% level because that's where I expect it to go on a triple leveraged ETF. Yes, the index may hit that 50% fib retracement or 32.3, any of the prime fib retracement levels, but because of this principle that we're seeing in leverage decay, the triple leveraged ETF may go 60 or 65 or 70% instead of to a 50% retracement, and there's no way of knowing what that correlation is. There's no way of developing a formula because it's going to vary month to month depending on the premiums they paid. So when you're trailing a position, you can't just put up daily price pivots or Fibonacci retracements and say this is where my trailing stop or this is where I want my initial stop, because they're not going to behave under those market laws that are generally accepted to be realities within the market. Many of those, I think, become self-fulfilling prophecies. We expect them, they go to that number, and then they rebound because we all expect them to do that, so we all buy at that point, and automated systems buy at that point. You can't do that with leveraged ETFs because instead of going to a 50% number, it may go 55 or it may go 75. You just don't know. There's no way of knowing. And they don't have to keep them balanced. All they care about is that individual day, trying to get it as close to possible. So that's an important factor to know. So what I'm going to do is show you some tools that we like to use to do 2 things. One, to assess where prime entries are when you're looking for a good entry to a trade, where your initial stop loss settings should be, and how to properly trail or some tools to trail a percentage trailing stop, because as we just saw, that percentage is going to fluctuate and change day to day. So just using a percentage-based trailing stop isn't really effective with leveraged ETFs. What I first want to do is let me explain what these indicators are, and I'm going to change a few as we go. And I'm going to say what I trade, the way I trade, the methodology that we use at Right Angle Trading is not necessarily right for everybody. What you trade may not be right for me. But as far as looking for prime entries, kind of where areas of support and resistance are, what are called price pivots, is it kind of looking for when to get out of a trade so that leverage decay doesn't start working against you, and ways of trailing stops. I think there's a number of tools that we can all use, and regardless of the methodology we're using, and that's what I'm hoping to share with you out of this. What we want is something that's very reactive to price on a daily basis. We don't want something that's going to really lag too far, and we don't want something that's a fixed price, fixed percentage, the way daily pivots are calculated, or the way Fibonacci retracement and Fib extensions and retracements are used. So we want something that's going to be reactive to the actual tradable leveraged ETF, be it double or triple. So I'm looking at an SSO daily chart. That's what I have up. In yellow, I just have Bollinger Bands. The green indicator, just straight out of the box, Bollinger Bands. The green indicator is a 20-period exponential moving average, and the purple indicator is a Keltner channel. The Keltner channel has two inputs. When you just throw any charting platform that you put the Keltner channel on, it's going to have two inputs. One's either going to say 10 or 20, and that's the midline, which is just a simple moving average. Most of the times it's 20. For some reason, default to 10. And the outer setting is going to be 1.5. That's the outer bands. In TradeStation, it's called average true range, number of average true ranges. It's different in every charting platform, what they call it, but the number is always the same, 1.5 when you first put it on. So we changed it to 2.5, and that's what we're looking at here. And what you can see is the reason we like that is the Keltner channel is a little narrower and doesn't overreact something like a triple or double averaged ETF the way the Bollinger Bands do, where it becomes somewhat ineffective out here with these large gaps, and it never really gets there in a move. So it's really not giving you as accurate a short-term trading range as the Keltner channel is at a 2.5 level. Now let's look at what I'm talking about just without the midline, and you can see very rarely, never more than 3 or 4 days at any given time, do we exceed the Keltner channel without coming back up into it at these settings over a long period of time. And this is true on leveraged ETFs, on daily charts, 60-minute charts, whatever time frame you want to look at. Now let's look at some simple methods of determining that also are going to be very reactive to price, of determining possibly where to set initial stop. So I have a 20-period exponential moving average in green. In blue, I have a 50-period exponential moving average, and red is a 150-period moving average. Never once during this trend does price close before the 150 EMA. Never once. So if I wanted to be in a long-term position in a leveraged ETF, I could use that as a trailing stop throughout the duration of this move. So I just want to point that out and make that aware of. Most of the times when we set a key price pivot, it's between the 20-period EMA and the 50-period EMA. It may poke on a tail only a couple of times when the trend is momentarily broken, and it comes down to test that next level. Do we ever go below the 50-period EMA? And most of these pivots occur in between. And when we get a blistering move, it really uses that, meaning a strong move up, it really uses that 20-period EMA as a support. So these are very, with the triple leveraged ETFs, with double leveraged ETFs, because they're very reactive to price. Let's look again at a TNA daily chart. TNA, a more volatile market, and again, you can see how that 50-period EMA, that space between the 20 and 50-period EMA, is very, very rarely broken, and if so, a very brief time, and only briefly once did this market ever go below 150 period EMA. So right off the bat, I know that a 50-period EMA is a really good tool for trailing a long-term position, and a short-term position, the 20-period EMA, is a good tool to show me where an implied area of support should be that's going to react to the changes in the leverage that occur on a daily basis. Let's look at the same principle on a shorter time frame. Same 3 moving averages on a 60-minute chart of a very volatile market, the Russell 2000. During this short 2-3-week trend, 1, 2, 3, 4, 5 times the 20 or 4 times the 20-period EMA provided support, once the 50-period EMA. So if you entered a position coming off the 50-period EMA, if your technical indicators told you to get long there, you could have just used the 20-period EMA to trail your stop all the way up to the top of the move. Very simple tool to use for trailing stops. When it came back down and broke, it again never went below the 150, never went below the 150 here for a few hours. It did, and when it did go below the 150 and stay there, we kind of had a trend change. Well, look what happened up top. Price pivots again. Now that 50-period EMA has become a resistance. And then when you get a choppy market, an indecisive market, you see it going up and down. That's a pretty good clue that you're in choppy trading conditions. But on the way down, the short-term, a lot of the key price pivots and on the way back up here are all occurring right at the 20-period EMA. So the 20-period EMA, 50-period EMA are 2 tools that we really like for short-term trading. And I'm going to show you some trade management on some actual trades that we issued via our end-of-day alerts and our intraday alerts, exactly as we teach them in our ETF courses. I'm going to show you 2 winning trades. I'm also going to show you a losing trade because I'm going to show you how these same tools can be used to spot. This was a higher risk entry. We're talking about risk management, knowing when a higher risk entry is than a lower risk entry. So let's start by looking at a TNA daily chart back this past February. And we were up, riding kind of up at the top of the Keltner channel, came all the way down to the bottom and broke down below. And we received a divergent signal to go long the TNA, and it was in February. It was on the 5th or 6th at the close of this day on this green candle. So based on some of the principles we've looked at, what I love about this trade is it's happening right at the 150-period EMA. It poked below it 2 days, kind of closed right on the edge of it 1 day, and now it's recaptured it. It's also spent 4 days outside that Keltner channel setting. And as we saw when we were looking at the charts, the daily charts earlier, 4 days, rarely did it ever stay outside the Keltner longer than that. And anytime it did, it typically returned to at least the 20-period EMA. So when I look at my entry into this trade signal, to me, you can't get a more picture-perfect, beautiful setup based on what I'm showing you. A great location to get into a trade, and I can enter it with a relatively tight stop using the prior day's price pivot because it's down below the Keltner. It's below all the EMAs, just right below. If it takes out that low with any strength, I want to get out of this position so I can enter with a relatively tight stop of about 6%. The next day, the trade immediately goes in our direction. I want to reduce risk. I want to go just under the 150-period EMA. If you recall, when we looked at the long-term, both the TNA daily chart and the SSO daily chart over the long term, only a few times did it ever go down and poke that 150 EMA. So if this uptrend is still intact, we should get a strong move off that 150 EMA. If it comes back down underneath it again, we're probably looking at a temporary trend reversal, and I don't want to be in a bull position. So I'm already going to limit my risk from where entry was here, so I'm cutting it down to about 2%. A couple of days later, what happens? Price comes up. Oh my God, I wish I could cover my screen and you would see it. Comes up and touches the 20-period EMA, and this is a point it could turn back down. So at this point, we're adjusting our stop slightly into profit to cover our commission, a little over break even, and we've removed risk in 3 days from the trade. As soon as, sure enough, the next day it kind of fights the 20 and 50 EMA, and then the next day it gaps way down and opens down. So we're thinking, wow, this may be a reversal. I'm glad I have my stop at least in a little bit of profit. But as the day progresses, it goes up and it recaptures the 20 and 50. We've got a crossover, which we don't pay a lot of attention to, but it is always a good sign. So we're going to put our stop right under the daily low. So now we're going to protect some profit because it's up above that 20-period EMA. I expect it to come back down and test the 20-period EMA, and it does that the next day. Then it kind of chops along for a couple of days and finally breaks up. After this chop period and it turns back up, I'm moving my stop up even farther, my trailing stop. A little bit of room below the 20 EMA to allow for pokes like we see over here in the tails. Those are market makers taking me, the little retail trader, out of our positions a lot of times, those little pokes. So you want to protect against that and leave a little room in there. Goes back up. As soon as it tags, closes up outside of that Keltner channel at the 2.5 setting, I'm going to move my stop up again. Just using the 20 EMA to trail all the way up. Now, we got an exit signal on this big blue square. I wish we nailed the tops that well all the time. We don't. I don't. I sure as heck don't. This was a good one. This was a lucky one. We got an exit signal there, and we get out with about a 24% gain. So we're in the trade for almost 4 weeks. We get a 24% gain versus less than 6% initial risk. So we're trading that trade where what we always look for, a 3 to 4 to 1 reward to risk ratio. That we want our winners on average to return at least 3 times what our losers are returning. And I had risk removed from this trade 3 days into it. By 3 days in, I had my stop up into profit. And using these tools, I was able to trail and keep a good amount of profit on the table while at the same time staying with it until I got a formal exit signal at the top of this move. We expect here, when we see this, we get an exit signal based on several divergences that were occurring. We expect it because what did we see before? Never did it really stay outside that Keltner on a daily chart longer than a few days, 4 days at the max. And every time it did that, we expect it to come back in and test at least the 20-period EMA or the space between the 20 and the 50. So we can look for a re-entry signal here to get back into the trade. Here, we want to get out, take our profit, and not let this leverage keep working against us, because at this point we were no longer returning 3 times, despite having 3 times the initial risk, we were no longer returning 3 times what the IWM was doing. The long-term leverage decay was starting to work against us. So that's a good point to get out of this trade. Now let's look at a losing trade. And just remember where this entry was and how I talked about this is a prime point for me, in my opinion, of when my technical indicators set up, momentum indicators and trend indicators to tell me divergences have occurred to get long. This is a great place to do it because I have a very high potential risk traveling at least to the 20 EMA and probably all the way back up to the top of the Keltner, a very high potential reward versus very low risk. So let's look at a trade that lost. And this is the DXD daily, double leveraged inverse or bear ETF for the Dow Jones Industrial Average. So when you're long the DXD, it's the same as being short the Dow with 2 times the potential return. We'd had a very strong move down in the Dow, move up in the DXD, came back down, kind of hoping a pivot would form right at the 20-period EMA and 50-period EMA because that shows there's some real strength and there may be follow-through in them, and came down to the lower band of the Keltner channel. But we had a higher low in the DXD. We had kind of broken the previous trend lines up here, going all the way up to the top of the Keltner, and we got what we call a very early in the trend potential new trend continuation signal. So we got long the DXD right here, and we made this call, on our end of day signals The problem I have with where we're entering this trade, and let's compare it here, as I said, we had just recaptured that 150 period EMA, and we had been outside the Keltner for 3 days, and came back up inside. Here, we had never quite made it outside the Keltner, never even poked outside the Keltner. We're still technically in a market uptrend, a downtrend for the DXD. The 150 period EMA is way up here, and the 20 and 50 are kind of hanging out here. And when I enter it, if all I do is move back to the 20 period EMA, I don't have a real great risk to reward because my initial stop is going to be placed just a little bit outside where the Keltner channel is when I enter the trade, because I expect it not to really poke too far outside there. So our initial risk on this is at about 4%, but the reality is if all I get is a one-day bounce in it, up to the 20 and 50 period EMA, it's going to have a tough time fighting through there going back up. I've only got potentially only a few percentage points profit in this trade unless I get lucky and go all the way back up to the top of the Keltner, and that's what I'm hoping for, and then I'm going to get 3 to 1. Hope means absolutely nothing in the market, and this trade immediately goes against us, and I call this a no-man land trade. And even though our technical indicators told us to get in, where it occurred, the price of the entry based on these tools that we like to use tells, and sure enough, it falls down, and we stop out of the trade 4 or 5 days later and take a 4% loss. So when I compare it to the TNA trade that had so much going for it for entry here, if you were bullish, if your technical indicators are giving you a bullish entry to get into the TNA, and so much room for this trade to run versus this setup, which is kind of in no man's land and it really hasn't reached an extreme, then I know this is a higher risk entry. And these are, regardless what you're using to trade, these are simple tools you can throw up on any charting platform and just see how often trades that are entered somewhere in there end up losing, and trades that are entered someplace like this end up winning. And I think you'll be amazed in any time frame. So now I want to look at a day trade, an intraday trade, and see how these same principles can work. And there's a couple of minor differences because I do day trade. I took this trade. I do day trade the Russell 2000. I don't really like trading the S&P 500 triple leverage ETFs intraday because they don't trend well. The S&P 500 only trends about 20% of the time. It trends about 5 times a day. Anybody who's ever traded the Russell 2000, traded the TF futures, knows exactly what I'm talking about there. You hit these phenomenal intraday trends on it for day trading, and it seems to do it almost every day, or certainly a lot more. I feel that way. I'll just briefly say, I don't know why anybody bothers trading the ES. I think the ES is the biggest joke in the trading world. It's 70% of it is automated trading, and they're all fighting each other. The Dow could go up, the NASDAQ down, like we saw today, and the S&P is just a flat, choppy mess, and you're paying $12.50 a tick. So when you make a mistake, it costs you $12.50 per contract. I don't understand the thrill of trading the ES. I quit trading the ES years ago, and have never looked back. I trade the NQ because it trends well, and I'm primarily taking trend continuation trades on an intraday basis. So I trade the NQ on range bars, and I get beautiful mini trends in it every day during prime trading, the first few hours of the market, and then I leave it alone in the afternoon. I don't know why I'm rambling on about this. It has nothing to do with the ETF market. I'm just betting. It's because I had an argument today with somebody who wanted to tell me how great the ES was for trading, and I was trying to convince this person that there are much better trading instruments in the futures world than trading the ES. Anyway, so we had a trend up working in the TNA, again, the triple leverage bull ETF for the Russell 2000, little trend working up, and on a 5-minute intraday time frame, it has a tendency to bust out of that outer Keltner and then use the outer Keltner as a line of support. And look at how often it just comes down and bounces. Once it's outside, you know you've got a runner. When it bounces off, and just other days, you'll get slow rollers. As soon as it goes outside, it comes back into the 20-period EMA. Now, I've got something else on here. I've got these funny little yellow dotted lines. That's another Keltner channel at 1.25. So what that's doing in theory is showing me half the distance between the midline and the outer band. And it's closer, it's actually a little tighter than what the out-of-the-box Keltner channel setting is. By the way, I just want to say, for those of you who know her, Linda Raschke actually was the first person to start. That's where I learned about the 2.5 Keltner channel setting. She's a wonderful market technician that I took a class of hers many years ago and learned about the 2.5 Keltner. And she swears by it, and I've really become a huge fan of it. I put it on all my intraday charts, whether it's futures or ETFs. But anyway, so I get a trend continuation signal that occurs right at the 20-period EMA. And you'll notice I don't have a 50 or a 150 on this chart because on a 5-minute time frame, those aren't really important. All I care about is a very short-term trade, and so all I'm going to do is focus on the 20-period EMA because that's where I expect support and resistance to be. I can also see when the market gets choppy, when just candles are going up and down over the 20-period EMA. It's a real good clue you don't want to trade because as it is over here on the right part of the screen, it's just too choppy for trading. So I get long this trade, and my initial stop is set. I'm using the 1.25 as a place, Keltner, the little yellow dotted lines, as a place to use as a stop loss setting. So my rule is when I close over the 20-period EMA on this signal, I'm going to use the stop at the next support area down, actively changing with the leverage support area, the 1.25 Keltner, and that's where I'm going to put it. A little bit below so that I can compensate for possible pokes. So you'll see the trade moved up in my direction. See how it stalls and gets choppy when it fights resistance right at that 1.25 area. Comes back down to test the 20-period EMA. And as soon as it does that, it pokes a couple of bars. I'm moving my stop up to a little bit below where these pokes are to reduce risk. My initial risk on this was at 0.5%. Now I've got less than 0.25% risk on the trade. So that's pretty good initial risk on a triple leveraged ETF. The trade shoots back up, and as soon as it breaks the Keltner, I'm moving my stop up under the 20-period EMA right here and into profit. And every candle that it's going up, every 10 or 15 minutes, I'm just moving, just glancing at the price of the 20-period EMA, cutting off about 12 cents, 10 cents because of the price of the TNA here. And I'm trailing my stop right along that 20-period EMA. And as soon as, and I know I've got a runner. So if this was one of those slow rolling trends where I expect it to go out, come back down to the 20, go back up, I may trade it in and out, or I may just, take half off and trail it the rest of the day. But in this case, I see that we've got a real runner, and it's going to stay outside the Keltner. The second it comes back in and closes inside the Keltner, I'm out of the trade. Because it's been out of there for so long, and I expect it now to consolidate around the 20-period EMA. But all along here, I'm just using my 20-period EMA for trailing the ETF up. So the end result is I had about 0.5% initial risk on the trade. I had a little under a 3% profit on the trade, so I traded at about 6-to-1. And the trade never really put me in danger of losing more than 0.5% on the position, which if you're trading something with triple leverage and you can enter with 0.5% of risk, because you're almost always going to be looking at a minimum of 2% return, using these as methods of recognizing exits or getting out of the trade and potentially jumping back in and also trailing your position. You're looking at that 4-to-1 ratio. This ended up at a 6-to-1 ratio, which is great. I'm always happy when that happens. It doesn't always happen. I got lucky on this one and caught that runner. But these are very useful tools that can help you. And again, it doesn't matter what methodology you're trading. What I'm doing may not be right for you. What you're doing may not be right for me. But as someone has pointed out, there was also, an evening star on the exit signal, which is great. Combine it with something else, and now you have confirmation, based on one of Steve's signals, something that he teaches here in Candlestick Forum. Boom, get out. I love combining things like that. I love saying, wow, I've got 3 or 4 different people's, different ways of recognizing a potential reversal to get out of the trade. So I'm getting out. But the real key here is how effective these tools can be for trailing a position, because, I really want to drive this point home. When you're dealing with a triple leveraged ETF, things like just using a percentage basis or Fibonacci retracement or price pivots aren't really effective tools because they don't obey those laws the way an index does, the way something without leverage does, the way even futures does. Even though they're heavily leveraged, they're going to track the index. The issue becomes, at any given time, there can be a huge change in the net asset value of these ETFs based on premiums of options. And a lot of the institutions that are trading these, day trading, the reason the TNA and TZA trade such phenomenal volume every day is institutions are trading them, and they're watching the premiums on those options that are in these so that they know when to get in and out before that decay works against them. And you could, that's a little complex for me. I've already got 4 screens. I don't need 2 more up to sit and watch options premiums on the Russell 2000. It's just, I'd love to. I'm sorry, but that's just one thing too many. These are still these are more effective tools that are very reactive to price that can be integrated into anyone's trading. So I hope you enjoyed this presentation. Hope you learned something about the ETF market. I'm going to do a very quick, just momentary sales pitch only to our friends at Candlestick Forum, because we've had a very good relationship with Candlestick Forum for a number of years. And so we've just opened up that we do every summer our live trading package, ETF Dynamics. It's our course and mentoring program, a $795 value. Our end-of-day ETF alerts through the end of the year, which means you get to see us making live market calls on the course that you're learning. It can also be applied to stocks, to futures, some very basic trending strategies and trend reversal divergence-based strategies. Monthly live trading webinars, and we do ongoing support via email. I have clients all the time emailing me chart pictures, jump on the phone with them, or we'll do a one-on-one webinar with you if you need it. It's an $11.38 value for only $4.95. I'm going to pop the link out to the whole room. I hope it goes through. I hope I know how to do this. Boom! And it's only for, our good friends at Candlestick Forum. So if you're interested in what we're doing with ETFs and want to learn a new trading strategy and at the same time be able to see it for many months in action, this is a great, very cost-effective package. I guarantee you'll make back what you put into it in a couple of trades. So that's the end of that, and you have the link there. Steve, I believe that concludes my presentation for the evening. What were the length on your Keltner? Greg, I want to answer that. The 20 and the 10 numbers don't really matter because they don't necessarily apply. So you have that 22.510 blessing, you give me that. So the 20 is the midline. That's 20-period simple moving average. The 2.5 setting, those are the outer bands. So yes, your 22.510, that will be effective. So they're called different things in different charting platforms. I have Thinkorswim as well, and I forget what they call it. It comes out of the box at 1.5. You don't want any offset. You don't want it. You never want to offset your Keltner. You don't want to do any of that. You just want to change those outer band numbers to 2.5, and you can kind of look at. You'll see them pop out about twice as far as they normally are. So that's how to get that setting for you. So anyway, thanks a lot, everybody. Becky, Steve, I'll hand it back over to you.
Hi, Brad. Thank you so much for joining us and showing us your wonderful method of trading. And everyone, we hope that you have a great evening. And Steve, we'll see you in the chat rooms tomorrow. Thanks, everybody. Good night.
Thanks, everybody.